So today we're going to look at posting from the journal to the ledger. Last time we looked at journalizing, and these are the journal entries we did for James Turbo in the last session. So today what we're going to do is we're going to take these journal entries and we're going to post them to the ledger. This ledger is in the form of T accounts, and the reason we use T accounts instead of a formal ledger at this point is because it really helps us illustrate debits and credits. A formal ledger will allow us to see the balance, the ongoing balance, and the different items and so on, where a T account really highlights the use of debits and credits. So we know that debits are always on the left of each T account, okay? Doesn't matter what type of account it is. We also know that credits are on the right. Now, whether we debit an account or credit an account depends on what type of account it is, as we've already learned. Posting to the T accounts is actually easy because we've already done the hard work in determining our debits and credits in the journal. Now, the journal is a day-by-day look at our transactions and what accounts are affected, but what it doesn't do is give us a balance for each account. So this is why we want to post. So posting, simply copying journal to ledger. And we're doing it in the form of T accounts. So our first transaction from December 1st, we have debit cash of $45,000. So what we do is we carry over the date. Now your book will show you to put the date in here, but if you do that on Excel, you're not going to be able to use the auto sum. So we're going to put the date out here on the left, and the date helps us cross-reference to the journal. If we have an error, we need to refer to something. We have a debit of $45,000 to cash, and then we're going to have a credit to James Turbo's capital account. So we're going to credit it, okay? And we're going to put the date out on the right, okay? Now also on December 1st, we have a debit to the delivery van. Now I can't see the delivery van on my screen, so I have a couple of choices. I can always print out the journal, and there I have it right in front of me, or I can always shrink down my screen so I can see more of it. But as you can see, that has its challenges as well. Okay, so what we're going to do is just find the delivery van. We know it's December 1st for $35,000. You have to be very careful and pay very close attention to detail because it's very easy to make what's called a posting error here, okay, which is essentially a clerical error. We have a credit to cash, also on 12/1, and we have credit to note payable. Remember, this is a compound entry. So our credit to note payable was for 15, I believe. I'm sorry, for 20. Okay. Okay, so now we're on the third, okay? I'm sorry, we're on the second. We have a debit to delivery equipment for $11,000 on December 2nd. Okay. And that was for $11,000. We have a credit to accounts payable. Okay. So again, very important that we pay close attention to detail. On the third, we have rent expense. Okay, so we have a debit to rent expense for $2,200. Okay. And then we have a credit to cash. Remember, we're not going to skip lines in the T account. Okay. On the 8th, we have a debit to accounts receivable, $5,000, and a credit to service revenue for $5,000. Now remember, that the revenue is not generated by when we get the money, but when we do the work, when we earn the revenue. So on the 9th, we have a debit to salaries expense for $10.25. And we have another credit to cash. We're going to find that cash is our busiest account because that's our medium of exchange. And we have a debit to maintenance expense for $2.10. And we have another credit to cash for $2.10. Okay, so right now all we're doing is just entering the items in the T accounts we're posting. Okay. So on the 11th, we have a debit to cash for $1,700. And we have a credit to accounts receivable for $1,700. Remember that debits are always on the left, credits are always on the right. Okay. On the 15th, we had a compound entry. We have a debit cash of $2,000. We have a debit to accounts receivable, $1,675, and we have a credit to service revenue for $36.75. Okay. So you can see things are starting to shape up here with our T accounts. Okay, and on the 15th, we have another debit to cash for $2,000. And we have a credit to unearned revenue, which is a liability, which we will explain later in a later chapter. So we should find this with the liabilities. Yeah. That's going to be a credit. Okay, and then we have a debit to accounts payable, which means we must have paid something off or paid part of something. So on 12/16, we have a debit of $2,500. Okay. And then we have a debit to salaries expense again on the 1st. So that was $10.25 again. And a credit to cash. And that was on the 21st, right? Okay. So on the 22nd, we have a debit to gas and oil expense. And that was for $80. And we have a credit to accounts payable. Now remember, every company would have a chart of accounts that would tell us which ledger accounts we're using. So these didn't just come out of the air, right? We would have to have a chart of accounts to go by, okay? All right. On the 27th, we had a debit to prepaid insurance for $2,400. And a credit to cash, $2,400. And then finally, on the 30th, we have a debit to James's withdrawal account for $2,200 and a credit to cash. Okay, so we can see that the T account will not give us a running balance like a formal ledger would, but we can calculate the balance. Okay, the first thing we need to do is determine if there are multiple entries. We can see for cash there is, we can see for accounts receivable there is. Prepaid insurance is only one entry. That's the balance. So I know your book tells you to carry it down and put the balance in there of 2,400, but you don't need to. If we only have one item, that's the balance in the account. And there are several here that only have one item. Now, there are several, though, that have multiple items. And when we have multiple items, we have to do some. Now, if we have multiple items on both sides of the account, we have to total both sides. That's called a footing. So let's start with cash, where we have 4 debits. So what we're going to need to do is we're going to need to do our bottom order, and then we're going to use the auto sum. And that's going to tell us we have a balance, we have a debit column total of 50,700. That's called a footing, okay? That's a footing. Just means it's the total of a column, okay? That's a footing. That is not the balance of the account. So now we have to look at the credits. Let's total those up. We have 24,060. Those are our total credits. So how do we determine the balance? Well, we can see debits exceed credits, so we know that cash must have a debit balance. That is what we would expect it to have, because the normal balance of an asset is a debit. So we're going to put balance over here, BAL. Center that if you want to. And we're going to take our total debits minus total credits. So our balance in cash is 26,640. Right? We would expect to have a debit balance. Same thing in accounts receivable. Okay? So we don't need to foot the credit side because there's only one item, but we do need to foot the debit side because we have more than one. So let's foot the debit side. And we get 6675. So our balance in accounts receivable, which is an asset, we would expect to have a debit balance. We would take our total debits minus our total credits. We have a balance of 4975. Okay, prepaid insurance is only one item. We don't have to do anything. Same with the delivery equipment and the delivery van. Now, accounts payable, we have 1 debit and 2 credits, so we need to foot the 2 credits. And we get a total credits of 11,080. Accounts payable is going to have a credit balance. We would expect that to be the case since it's a liability. Liabilities have a normal credit balance. So we're going to take our accounts payable credits minus the debits, and here's our balance in accounts payable. Okay? So this means we owe our vendors $85.80. Okay? Our customers owe us $49.75. Okay, unearned revenue and note payable, they only have one item. There's nothing to do there. Capital withdrawals, service revenue, we have 2 credits. Okay, there's nothing on the debit side, so we don't need to foot. We can simply just total this up to get the balance. So we have revenue of $86.75. Salaries expense, we have no credits, we have 2 debits. So we just need to add up the debit side to get the balance because there's nothing over here. So we have our balance of $20.50. We have rent expense, maintenance expense, and gas and oil expense are only one item. These MPT accounts aren't going to hurt anything by being there. So that's journalizing and posting. We did the journalizing in the previous session. Now we've posted to the ledger. Our next step is to do the trial balance. The trial balance will give us a summary of all of our accounts and balances and verify that debits and credits. So we'll do that in our next session. Thank you for your attention.